Hello everyone. The topic of our video today is cash flow statement. We will consider such questions as what is the cash flow, its classification, what are the methods of its analysis, as well as the reasons for the increase in the inflow and outflow of funds. Cash flow is a change in the balances of funds in bank accounts or cash desks of the organization. In order to reveal the real cash flow at the enterprise, to assess the synchronicity of receipts and their expenditure, as well as to link the amount of the financial results obtained with the state of funds, it is necessary to identify and analyze all directions of receipt, inflow, and expenditure, outflow of funds. The main source of receipt of funds is sales revenue, accounting income from ordinary and other activities of the enterprise for the reporting period. Profit is the difference between scientific income and accrued expenses related to the production, sale of products, and provision of services. Cash flow reflects the indicator of cash flow, which includes cash inflow reflecting their receipt, outflow of funds reflecting their expenditure, net cash flow reflecting the difference between their inflow and outflow. Cash flow reflects the flow of all cash, including those that are not taken into account when calculating profits, capital investments, taxes, penalties, debt payments to creditors, borrowed and advanced funds. Cash flows are classified by the timing of investments that cause outflows and inflows of funds according to the main activities of the enterprise: production, investment, financial. The main characteristic of any economic entity operating in a market economy is the implementation of its production activities. At the same time, production activities are carried out in various forms in different sectors of the economy by individuals and legal entities. Production activity is the activity of a company aimed at achieving the main goal of the business, generating income and managing variable costs and expenses to make a profit. The slide shows the cash flows generated by production activities. Investment activity includes operations related to real and portfolio investments of a long-term nature, cash, various securities, property that is subject to financial assessments by maybe investments. Investments can be aimed at preserving capital, for example, buying antiques or precious metals, which after many years do not lose their value. Also, investments can be focused on increasing capital. In this case, by investing money in a business, investment instruments or property, the investor seeks to make a profit. Financial activity is related to short-term financing operations of the enterprise. In international practice, financial activities refers to cash flows associated with changes in the composition and amount of equity and loans of an enterprise, including bank loans. Changing in equity in this section of the report are related to the issue of shares or other monetary increase in the authorized capital, as well as the issue income received. Cash flow management is an integral part of company's liquidity and solvency management and allows regulate the liquidity of the balance sheet, optimized working capital by investing in risk-free assets, plan capital expenditures and sources of their financing, forecast economic growth. There are two methods of accounting and estimating cash flows. Direct, with its help, you can determine the main sources of cash inflow, the main directions of cash outflows, value of net cash flow, excess of the amount of current liabilities to the budget and personnel by the inflow of funds and core activities. Indirect, it involves the use of balance sheet and profit and loss statement data and allows you to determine the relationship between different types of enterprise activities, net profit and changes in assets for the reporting period. In the process of analyzing cash flows, it is advisable to find out the reason for changes in the inflow and outflow of funds. The increase in cash inflows can be caused by attraction of short-term loans, the growth of equity, the sale of excess property of the enterprise, etc. An increase in cash outflow may be caused by a slowdown in asset turnover, an increase in the absolute values of inventories and receivables, an increase in sales costs, an unjustified increase in dividend payments, etc. Cash flow management assumes its reduction to zero due to the fact that a negative balance for one type of activity should be compensated by a positive balance for another. The cash flow reports helps to see account balances, understand where the money comes from and where it goes. Analyze the cash flow by project and directions. The cash flow statements will not replace other management reports. It does not take into account the company's obligations. It is difficult to correlate accurate method and profitability to work on it. Entrepreneurs who evaluate a business only by account balances run the risk of running into deficit and unprofitability. Thank you for your attention. See you in the next video.